Welcome to the Deep Dive. Today we're really digging into the Q3 2025 earnings call for Wingstop. That was held November 4th.
Yeah, and this one it really gave us one of the more, let's say, curious financial prints we've seen this quarter, a real mix.
Definitely a study in divergence, like you said. So our mission today is to unpack how Wingstop's management basically convinced investors that their big strategy, hitting $3 million in average unit volumes, AUVs,
That big $3 million target,
is totally on track, even while, and this is the key, they're facing these pretty noticeable macro headwinds, especially with traffic in the whole QSR space.
And the market absolutely read it. I mean, the stock jumped, double digits intraday?
Yeah, huge pop, signaled massive enthusiasm from investors, really focused on that underlying profitability and I think the very aggressive long-term growth story.
Okay, but let's start with the snapshot first, because the numbers themselves, they were wildly mixed, like you said.
Right. So bottom line, adjusted EPS came in hot at $1.09.
Which crushed consensus. Consensus was sitting around, $92.93? That's like an 18, maybe 19% surprise beat. Pretty substantial.
A massive profit beat, exactly. But then you look at the top line. Total revenue, $175.7 million.
Yeah, that actually missed consensus by roughly 4% to 5%.
So beat on profit, miss on revenue. But okay, they still showed decent system-wide sales growth, up 10% to $1.4 billion.
And adjusted EBITDA hit a record $63.7 million, which, just confirms the power of that asset-light franchise model they run. Almost 19% growth year over year there.
Okay, record EBITDA, strong profit beat.
Yeah.
But here's the tension point, the big one. Domestic same-store sales, SSS.
The metric everyone watches for existing store performance.
It declined by 5.6%.
Oof, yeah. That kind of number, 5.6% down, usually sends a QSR stock absolutely tumbling.
Into the abyss.
Yeah.
Right, you'd Wingstop soared. So this is the disconnect we really have to unpack. Why are investors looking past a pretty significant sales miss just because of a profit beat?
Well, I think it boils down to the quality of that profit beat and where it came from. A big piece starts with the supply chain.
Yeah.
Profitability got a major boost from lower input costs, specifically for bone-in wings, that flowed right through.
How much?
It contributed to a 300 basis point drop year over year in their company-owned restaurant cost of sales, COGS. That fell to 74.8%.
300 basis points is huge. So cheaper wings meant fatter margins. Simple as that.
That was a big part of it, yeah. But it wasn't just a lucky commodity break, though. They showed some real operational control elsewhere.
Like SG&A.
Exactly. Selling, general, and administrative expenses. That line item actually decreased, and it was mainly due to lower short-term and stock-based incentive comp.
Okay, so that points to some genuine discipline, leaner corporate operations. They're tightening the belt where they can.
And critically, this wasn't just a one-quarter thing. Management gave some pretty remarkable visibility going forward. They said they have line of sight into food and packaging costs staying right in that targeted mid-30% range through all of 2026.
Wow, okay. That kind of predictability, that's gold. Especially for franchisees, right? Yeah. It gives them confidence that these healthier margins aren't just a blip, they're actually sustainable.
Absolutely. Takes a lot of risk off the table for them.
All right, so profitability looks strong, it seems pretty clean, driven by costs, but also some discipline. But how are they managing this massive expansion? Building so many new stores when lots of other chains are slowing down.
Yeah, that brings us to the other half of this bullish story, the unit growth engine. It's just accelerating.
How fast?
Q3, a record 114 net new restaurant openings. Record quarter. Year to date, they've opened 369 net new spots.
Which puts their unit growth rate at?
A massive 19%. They're getting close to 3,000 restaurants globally now. Just relentless growth.
Okay, 19% unit growth is phenomenal. What's enabling that pace? Is it just momentum?
It's the unit economics. They're just incredibly compelling for franchise partners. You look at the domestic average unit volumes, AUVs, they're currently at $2.1 million.
Which is already really strong.
Very strong. And that supports unlevered cash-on-cash returns of over 70%.
70%. On what kind of investment?
On an average upfront investment of just about $500,000.
Okay, let's pause on that 70% number for a second. For anyone listening who isn't deep in franchise finance, unlevered cash-on-cash basically tells a franchise how fast they get their total investment back, assuming no debt.
Right. And 70% means they recoup that initial $500,000 in less than 2 years, maybe closer to a year and a half.
That kind of return isn't just healthy. In the QSR world, it's kind of an outrageous number. It basically makes their expansion almost financially unstoppable.
Which explains why they felt comfortable enough to actually raise their global unit growth guidance for 2025, now targeting 475 to 485 net new units.
And looking into next year.
They're projecting a mid-teens unit growth rate throughout 2026, still well above their long-term target algorithm of 10% plus.
So the pipeline is just packed.
Absolutely packed. And that conviction is fueling the international push, too. Management made a point to highlight finalizing what they called a landmark agreement for India.
India. How big?
They see it as a 1,000-plus restaurant market opportunity. Massive. This is a major acceleration of their global footprint push.
Alongside other markets.
Yeah, they mentioned ongoing expansion in the GCC, France, the Netherlands, and they've got plans teeing up for Ireland, Thailand, and Italy, too. The global runway is huge.
Okay, so let's recap the bull case. Exceptional underlying business model, really clean profitability story, and this accelerated unit growth, both domestic and international. It's powerful.
Very powerful, but we still have that elephant in the room, that 5.6% same-store sales decline.
Right. Still looming. Management didn't shy away from it. They confirmed it was from softening demand, and it wasn't just low-income consumers anymore. It broadened out to affect the middle-income group, too.
And as a result, yeah, they had to cut the 2025 domestic SSS guidance pretty sharply. They took it down from roughly positive 1%.
Yeah, low single digits positive.
Down to a decline of 3% to 4% for the full year. That's a big reset.
So weaker demand is real, but here's where the strategy comes in. Instead of just hitting the discount button, which they seem determined not to do.
Right, they want to protect those unit margins.
Yeah, they laid out this, I'd say, high conviction 3-pillar strategy, all aimed at getting SSS back positive and driving towards that $3 million AUV target in 2026.
Okay, pillar number 1, the Wingstop Smart Kitchen, WSK.
This is their new tech-enabled operating platform.
Exactly. It's now live in over 2,000 restaurants already. And it's not just, fancy ovens. It's using tech to manage order flow, cooking times, basically streamline the whole operation.
What's the goal?
Speed. Consistent 10-minute speed of service. That's like a 50% plus reduction in prep time. They want reliability.
And is it working? Do they have proof?
They pointed to the Southwest region. That's where WSK has been in place the longest. And that region is already seeing mid-single-digit SSS outperformance compared to the U.S. average.
Okay, so early signs are positive. It helps throughput.
Helps throughput, improves consistency. And they also mentioned that 100% of restaurants showed improved guest satisfaction scores after just 8 weeks of implementation.
And that 10-minute speed, that's crucial for their core customer, right? The group orders, the off-premise occasions, less waiting, more reliable.
Means higher repeat business for those crucial party-sized 2+ adult orders. That's the sweet spot.
Okay, so WFK is pillar 1. What's pillar 2?
Pillar 2. A new marketing campaign. They're calling it Wingstop is Here.
Wingstop is Here. What's the angle?
It's aimed squarely at broadening the top of the funnel, just getting more people aware of Wingstop. Management basically admitted their current market share in their core demand space, those off-premise group occasions, is only about 2%.
Only 2%. Wow, what's the target?
Long-term target is 20%, so there's a huge awareness gap compared to the big legacy national brands. This campaign is designed to start closing that gap.
Makes sense. Okay, pillar 3.
Pillar 3 is Club Wingstop. That's their loyalty program. It's targeted for a national launch late in Q2 2026.
Loyalty. Do they even have one now?
Not really a formal rewards program, but they already have this massive database, over 60 million users, just from people ordering digitally.
60 million contacts without even offering points. That's impressive.
It is. And what's really crucial here, they stressed this won't be your typical discount-driven loyalty program.
No BOGO coupons every week.
Exactly. They're focusing on hyper-personalized experiences, maybe curated content, exclusive flavor drops, things to drive frequency and build loyalty without just giving away margin.
Using data to change behavior, not just prices. Protecting those unit economics again.
That's the plan. It's all about leveraging that data they already have.
Okay, so when you put it all together,
yeah,
the investor context clicks into place, doesn't it? The market seems to be saying, look, we see the SSS softness, we get the macro pressure, but we really like the clean profitability beat driven by costs and discipline. And we love the accelerated unit growth runway pushing into mid-teens next year.
Yeah, they seem to be viewing the SSS issue as temporary, cyclical, something that this 3-pillar strategy, the Smart Kitchen rollout, the new marketing push, and then layering on loyalty next year will eventually fix.
And management is backing that view with their capital returns, right?
Absolutely. They declared the regular quarterly dividend, 0.30 cents per share, and they were active buying back stock too. Repurchased about 140,000 shares in Q3.
At what price?
Average price was $285.26. And they still have like $151 million left on their current buyback authorization. So they're signaling confidence, putting money behind that long-term unit expansion story.
Okay, which brings us perfectly to our favorite segment. This is not financial advice.
The outrageous but plausible trade idea.
Exactly. So given everything we discussed, the stock's huge jump after the call, the underlying operational strength, that massive unit growth pipeline, how do you structure a trade?
Well, you need to leverage that conviction in the growth story, but still acknowledge the, let's call it, near-term uncertainty around same-store sales.
Makes sense. Hedge the risk, play the strength.
So the outrageous but plausible idea, focus purely on the international runway.
Okay. Why international specifically?
Because that landmark India deal, the 1,000 plus unit potential, it validates the global scale opportunity. But often, that international value gets heavily discounted by analysts who are laser focused on, quarter-to-quarter domestic comps.
Right. The market underappreciates the long-term global story sometimes. So what's the specific trade structure?
The idea would be something like this. You initiate a core long position in the stock, just own the equity, but you pair that with strategically buying some out-of-the-money, long-dated call options.
Long-dated meaning?
Like maybe 18 months out, giving the story time to play out. And these calls should be specifically tied to, say, the successful execution of that India pipeline, hitting milestones, and maybe achieving the high end of their 2026 unit growth target, that 475 to 485 number.
So you're betting specifically on the unit growth narrative, especially internationally.
Exactly. The core premise is this. If that India pipeline alone starts executing successfully, it could force a multiple re-rating for Wingstop stock.
Explain multiple re-rating quickly.
It's basically when the market fundamentally changes its mind about how much a company is worth, decides it deserves a permanently higher valuation, a higher PE multiple, because it's proven it can scale effectively into a huge new market, like India.
Got it. So the unit growth, particularly international, becomes this unstoppable catalyst that eventually makes people forget about any temporary domestic SSS wobbles.
That's the thesis. The unit growth story potentially overwhelms everything else long term.
Interesting. Okay, so let's recap the whole quarter then. We saw definitely a clean profitability beat that was fueled by good cost control, lower wing prices, but also some real discipline.
Confirmed. We also saw record unit growth pace continuing strong, with management actually boosting guidance for this year and signaling an aggressive mid-teens outlook for 2026.
And they laid out that very clear, high-conviction strategic plan. WSK, the new marketing, the smarter loyalty program, all designed to fix the comps and keep pushing toward that $3 million AUV goal in the long run.
Right. It's a clear narrative they presented.
But here's the final provocative thought for you, the listener, to mull over. Management stated pretty clearly that their business right now over-indexes to the consumer segment that's under the most economic pressure.
Yet they remain vehemently anti-discounting. They do not want to sacrifice those margins.
So the question is, how quickly can the rollout of the Wingstop Smart Kitchen and that new Wingstop is Here marketing campaign actually succeed in diversifying their customer base? Can they attract more higher income folks before the macro environment potentially forces their hand on pricing?
Yeah, can they execute fast enough to avoid having to revisit that anti-discounting stance? That's the real tension, the ultimate thing to watch in the coming quarters.
It absolutely is. Well, that wraps up our deep dive for today. Thank you for joining us.
And remember, as always, this has been analysis and discussion, definitely not investment advice. Keep digging into the topic yourself, and we'll catch you on the next call.